Hello and welcome, everybody. I'm Eric Patten, Cutler's Chief Investment Officer, and I'm joined today by Stanley Barnes, a chartered financial analyst here at Cutler, and we're both in our Bellevue office here in Washington. But we had a lot of interest in today's webinar, and I think that might have something to do with stocks being at all-time highs or with the election right around the corner. But we're going to tackle all of those questions here today. Without further ado, let's get started. And we always begin with some disclosures. And I think the important or the pertinent point here is that there's a lot of new information that's going to become available in the fourth quarter. And we will adjust our views as new information comes available. But today is our best guess of how things might go and where we see value and opportunities out there. All right, so on today's agenda, the theme of today's presentation is timing the market is hard to do. You see a little picture of a pocket watch in the corner of the slide here. And we have that picture throughout today's presentation. So you're going to see it a lot. Whenever you see it, that's a reminder that timing the market is hard to do. There's a lot of slides on that theme. But we're going to start with a market review and outlook. Stocks are at all-time highs. They just hit their 47th all-time high of the year. Then we're going to move on to Fed Watch. We've called that chapter Surprise. The Fed definitely is probably the most important variable in determining the direction of stocks. So what the Fed does is very important. Closely related to the Fed is our economic outlook. And we've entitled that, Where's the Bad News? And then finally, investing through the election, part two. We tackled this last quarter as well. A lot has changed from last quarter to this quarter in terms of the election and who the candidates are and what the expected policies might be if either party were to win. Stanley, why don't we jump into what's happening in the stock market, and you can give us a review of the third quarter and tell us what happened over the summer.
Yes. So starting off with the different asset classes on the left side, with bonds, we have the Vanguard Total Bond Market ETF. That is a proxy for the US bond market. That was up 5.2% in the third quarter, which is really an incredibly strong return for the bond market overall. And that's something that you usually see as maybe an annual return, 5.2%. To have that in one quarter is really quite remarkable. Moving on to equities, with the S&P 500, that index was up 5.75% in the third quarter. Again, quite a strong return. Generally speaking, one of the higher returns you'd seen in the quarter, but it was actually dwarfed by international and small cap stocks. So foreign stocks, as proxied by the MSCI EFI ETF, essentially foreign developed and emerging market stocks, that was up 6.77% in the third quarter. And then finally, small cap stocks were actually up 9.2%, an incredibly strong return, primarily driven by the Federal Reserve starting to lower interest rates, as small cap stocks tend to have a lot more short-term debt on their balance sheet. Something else I would also like to point out is on the right side, we have what we call our asset class convictions. These are what Cutler Investment Group views as what we would overweight or underweight relative to our benchmarks. So as an example, for global REITs and alternatives on the bottom, we are underweight those areas. We do not like those areas on a relative basis, versus if you look at US small cap blend, mid cap blend, and large cap blend, we're a lot more bullish on those areas.
Yeah, and I'd like to add, even though small cap stocks, for example, were up 9.2% in the quarter, it was not in a straight line. It was a pretty bumpy ride. You think back to July, the unemployment rate came out at 3.4%. And that triggered this is a little wonky, but it triggered something called the SOM rule, which has been a recession indicator. And the SOM rule is if the unemployment rate goes up 0.5% in a short amount of time, that rule gets triggered. Well, that really impacted expectations for Federal Reserve rate cuts. It put some pressure on the dollar. The yen appreciated. You heard a lot of news about the yen carry trade. And then the S&P sold off with its biggest sell-off in 2 years. Well, as the quarter progressed and as the summer moved on, the expectations for the Fed to play catch-up began to be the dominant theme of the quarter. And really, the Fed came through in a big way in meeting those expectations. That's how we got to that 9.2% in small caps and that 5.7% in the S&P 500. Stanley, this is our quilt chart. We walk through this every quarter. Anything jump out to you on this? On
Yes,
this?
on the right side, you'll see year by year returns. And what I would point out is that 2024 so far, the top two, large cap growth and large cap stocks, those have really been a repeat of 2023 when they were the highest returning asset classes. They are again in 2024, which is kind of opposed to what happened during the 2022 bear market when large cap growth was the worst performer. What I would also note in 2024 is that every single asset class is up year to date, which is pretty rare to have every single item up. On top of that, the number three returning asset class, emerging markets, has had a really strong 17% return. That's pretty strong for emerging markets. International starting to do a little bit better relative to how they did last year.
Yeah, and when I look at this chart, I see a lot of good news, especially now that the financial crisis has dropped off. Without 2008, look at the black square on this chart, and that's the S&P 500. And you can see very consistently over the last 15 years, it's had some great years, some great returns. Only two of those years was it negative, 2018 and 2022. But there's, plenty of mid-teens, 20% plus, even a 30% plus year on this chart, two 30% plus years. Sorry. It's been a great run for stocks. And let's look at that another way. Let's look at this year to date, with the S&P up 24% year to date. It's shown here on the green line, and the average of the last 33 years is shown on the blue line. And you can see we've trended higher really throughout this year. Currently, we're about 4 times higher on a year-to-date return than on average. So it's been a phenomenal year for stocks. I think there's a lot of people on this call that might be asking the question, should I sell with stocks at an all-time high? And, this is our first of the market timing market timing pages. Stanley, can you try to answer that question for us, looking at the data on the page here?
Yes, and first to answer your question, the answer is no, do not sell your stocks even if they're at all-time highs. Looking at this, we have in blue the S&P 500 year by year and how many times in that year it reached an all-time high. And you're seeing numbers that are extremely high. For example, in 2021, there were 70 new all-time highs. 2024, so far we've seen 45 year to date. There's no reason to think that that can't go higher. I mean, there's more than 50% chance of the market going up on average, so it could very well continue to go up, and we could see more and more all-time highs. But the point is, anytime the market reaches an all-time high, that is not by any means an indicator to sell off or get out of stocks or even position more conservatively. I would stay invested with your recommended investment allocation.
Yeah, I think back to 2007, and if you were lucky enough to sell at the peak of the market before the financial crisis, when it, one of those 9 days when it hit the all-time high, 5 years later, you would have recovered all of your money. So even if stocks, do sell off, usually the market does recover, it does come back. That's going to be a theme of today's presentation, and we'll see some other ways of looking at that. Here's a chart that Goldman Sachs put out, another page about timing the market. And this is really hard to understand from a math standpoint. But if you invested at the all-time high, you actually have better returns than if you invested on the other days, which is the unconditional investing day. So this shows how your money would have returned on an annualized basis if you only invested on days when it hit an all-time high. And on average, 1 year, 12 months ahead of time, you've done better than on all the other days. And 3 years and 5 years, similar data. So again, it's very difficult to time the market, and we are not suggesting that being at an all-time high is a reason to sell. We think being at all-time high is why you invest in the stock market. So Stanley, that's a lot of good news and a lot of optimism. Is everything optimistic out there? Can you try to poke holes in this thesis a little bit?
Yes. So one of the things that historically has ended bull markets is that they run out of steam. Currently, right now, this is looking at the S&P 500 price to earnings ratio and where it's traded over time. You'll see that during the depths of the financial crisis in 2008, it got all the way down below 10 times earnings, which is extremely cheap. Right now, we're currently at about 21.5 times earnings, which is pretty close to where we were at during the tech bubble as well as during COVID. It is a little bit of cause for concern. That being said, over time, those large cap tech companies have become more and more dominant within the S&P 500 and represent more and more of its market cap. And those large tech companies have had really strong earnings growth over the last few years, and they're expected to continue with quite strong earnings growth going forward as well. So what I would say is the S&P 500 is a lot more growthy than it used to be, and there's going to be more earnings growth, which gets factored into that higher price to earnings ratio. So looking at this chart right here, on the left side, we have in green, the Magnificent Seven, those big tech companies. In blue, the S&P 500, omitting the Magnificent Seven, and then in gray, the S&P 500 with everything combined. Obviously, in 2024, 2023, the Magnificent Seven had really strong returns. S&P 500 was up overall, with the rest of the companies, 493 in there, a little bit more muted returns. On the right side, the earnings growth has been one of the main drivers there. So again, 2022, negative earnings growth for the Magnificent Seven when they had a bear market. The rest of the market didn't fare quite as poorly. And then 2023 and 2024, we had very strong earnings growth for those Magnificent Sevens. Going forward, we're actually expecting to have a little bit stronger earnings growth for those other 493 companies. But overall, we're expecting a lot more convergence between the 493 as well as the Magnificent Seven. So right here, again, 2023, 35% earnings growth, negative 4% for the S&P 493. Same story in 2024 so far. And then looking at 2025 and 2026, earnings growth expectations for those S&P 493 companies are really a lot stronger relative to this year and last year. And the Magnificent Seven are expected to still have strong earnings growth, but less strong than they had in the past couple of years. We're really seeing a convergence there where we'd expect those cheaper companies, those smaller, cheaper companies, maybe a little more value to have stronger performance just because they're going to have stronger earnings growth, especially relative to the Magnificent Seven.
Yeah, and when you think back to our convictions, our asset class convictions, I think this chart is a great summary of why we feel the way we do. As these numbers compress, as less of the S&P 500 return is coming from those 7 stocks, the valuations of the other 493 are more and more justified. So we like diversification. And we advocate for diversification, but we really do believe that those value sectors, those dividend stocks right now have a lot of value in the stock market. All right, so let's talk about the Fed for a little bit. Stan, I do have to comment, our lighting is a little bit off. I think the sun came out in Bellevue, which is a rare occurrence in the fall. If it's a little dark to see me and a little bright to see Stanley, we're facing opposite directions. So that's an explanation there. But let's talk about the Fed instead. Surprise! What happened with the Fed? Well, here's what happened. The Fed lowered interest rates with a surprising jumbo half rate cut. And the market had, this was a possibility. It wasn't completely out of left field. There was a 25% chance that the Fed would do 25 basis points, it was basically a coin flip to do 25 or 50 basis points. But the Fed decided to do 50, really the more aggressive cut. And I put a picture of Jerome Powell here. I think this picture looks very victorious. He's declaring victory on inflation. He's cut rates 50 basis points and landed the plane to a soft landing, which that had been the discussion for the last several years. Would the Fed be able to navigate a soft landing, which means avoiding a recession, yet bringing inflation down? And the 50 basis point cut really was declaring that inflation is no longer their priority. Unemployment is their priority. Full employment of the economy is their priority. And the Fed is now focused on growth more than they're focused on inflation. Stocks love that. Bonds love that. That's why we saw that third quarter, those third quarter returns that we did. But what do investors love? Investors love more rate cuts. What will you do once the Fed cuts rates? Ask for another one. One is never enough. So, Stanley, what is the expectations for what the Fed is going to do from here? What do you think is going to happen?
So right here, we're looking at what is called the Federal Reserve dot plot, and they take the voting members of the Federal Reserve and they lock in their rate expectations for where they expect rates to be in the future. So if you're looking at 2024, we have the bulk of the Federal Reserve voting members have it in the, ending 2024 in the 4.25 to 4.5% range. And then you'll see as we move into 2025, pretty much across the board, the expectations move lower, somewhere between the 2.75 to 4.25% range, and then a little bit lower in 2026. And it kind of evens out where 2026, 2027, over the long run, it should be in that 2.75 to 4.0% range. But the main point here is in 2025, we expect rate cuts to continue. interest rates will start going lower on the lower end, the Federal Reserve's rate. And it really should get down to the 2.75, 3.5% range, somewhere in there. Expect the Federal Reserve to continue to cut interest rates, although it may slow down the pace of rate cutting. And then right here, we're looking at returns around Federal Reserve interest rate cuts. On the left side, we have the S&P 500 returns around the time that the Federal Reserve starts cutting rates. So what you'll see is when the first rate cut happens, generally speaking, the market tends to go up and take off a little bit. There are two exceptions to that rule. 2007, the Great Financial Crisis, when the Federal Reserve had to cut rates rapidly because there was economic calamity everywhere. And then 2001 was another example there where there was the tech bubble. But otherwise, generally speaking, markets tend to go up when the short-term interest rates come down because businesses can borrow at a lower rate of interest and they can invest in factories, build more, hire more, etc. On the right side, we have the U.S. government 10-year bond return around the time that the Federal Reserve starts cutting rates. And again, overwhelmingly positive. Main reason being bonds are priced via the discount rate that the Federal Reserve uses. And as they cut short-term rates, future bond interest payments become more and more valuable. And so bond prices tend to go up, returns tend to be positive.
Yeah, and I think the big differentiation here is the Fed cutting into economic strength or into economic weakness? And that makes a difference in terms of your return expectations around a Fed cut. This is another way of showing the same data. We once again have our market timing picture on the page here. This is all about, should you be worried about the Fed, what the Fed's doing? And we would characterize this cycle as a slow rate cycle. The Fed is cutting slow. In fact, that dot plot chart that Stanley showed you a couple slides ago shows about 250 basis points, 2.5% of Fed cuts. The market actually thinks it will be less than that, maybe around 2%, because we're seeing growth, because inflation is not yet at the Fed target. The market is saying, not so fast. Let's anticipate slow rate cuts. Well, look at the right side of this page. The difference between a slow rate cycle and a fast rate cycle. And you can see the returns for a slow rate cycle are vastly better than a fast cycle. So that's another reason for us to be advocates for stocks. That's why we think we're comfortable with our allocations and we're not selling stocks vis-a-vis bonds at this time as well. Stanley, I just mentioned inflation being a little stickier maybe than anticipated. You can see here it's at 2.4% right in the middle of the page. Anything else on this slide that we should cover for everybody?
Well, I would really just note that, again, in red, you have the peak inflation, 9.1% in June of 2022. Blue, you have September 2024, so about a month ago. And every single item has a lower inflation rate than it did in June 2022. Some items are still elevated: transportation, shelter. Shelter tends to be a little bit more backward looking, so it tends to lag a little bit. But overall, if you look at gasoline, fuel, oil, used cars, new cars, those actually have negative rates of inflation. And everything else is coming down quite a bit. So inflation really has come down quite substantially. It's not quite to the Federal Reserve's 2.0% goal. It's at 2.4% right now, but we are trending in the right direction. One of the main reasons the Federal Reserve is starting and continuing to cut interest rates.
So September ended with everything being good news. Inflation was down, the Fed was cutting rates, stocks and bonds were at all-time highs, the housing market was at all-time highs. October has been a little bit different, and not that stocks have sold off, but bonds have sold off. And this has been a change in the narrative a little bit. And you can see on this chart, red is a month ago, blue is today. Higher is bad for bond prices and lower is good because yields and prices are inversely related to each other. So focus on the 10-year number, and you can see the 10-year a month ago was at about 3.6, and today it's sold off and is at about 4.2. That actually is an opportunity for bond investors. For investors that might be sitting in cash, and we're going to talk a lot about cash later in the presentation, they might be looking at that 10-year treasury and saying, hey, I can lock in 4.3% for 10 years. That sounds like a pretty good deal, risk-free. So this is something to keep an eye on. In terms of risks out there in the economy, there aren't a lot of them that we can identify right now. There's a lot of risks we can't, or unidentifiable risks, such as war in the Middle East and not knowing how that's going to spread, for example. This is definitely something we'll be watching here at Cutler to see how this unfolds and really positioning bond portfolios to take advantage of these higher rates. So if you have a portfolio, for example, heavier in that 2 to 5 year time horizon, perhaps you look to that 5 to 10 year time horizon and capture some of those higher rates. All right, so let's talk about the economy, some key economic indicators. The first is the yield curve. We've been talking about the yield curve for years, and the reason was we just had the longest yield curve inversion in history, and it ended in the third quarter, finally. That's good news. You want an upward sloping yield curve because that suggests that the future is positive, that there's growth down the line, and that the Fed doesn't have artificially high constraints on the short term. And what we've had is the inverse of that, where the Fed has raised rates all the way up to 5.25%, but long-term rates didn't go up, so the yield curve has been downward sloping. Well, that's another recession indicator, and there have been a lot of recession indicators over the last couple of years, yet no recession. We had the SOM rule, which I mentioned earlier. We had the downward sloping yield curve. We've had the consumer confidence has been very low. So if you look at a lot of these economic indicators, a lot of them have suggested a recession, yet we have not had one. Moving past that, though, here's what happened typically when the yield curve uninverts. On average, you'll see the Russell 1000, which is a broad stock index, returns 6.5% over the next 3 months, 6% or 9% over the next 6 months, and 18% over the next 12 months. That's yet again another positive sign for stocks. Just because the yield curve has uninverted does not mean that you need to sell stocks. What about growth, Stanley? Where are we in terms of GDP growth?
So right here, looking at the Atlanta Federal Reserve GDP Now estimate, they're expecting roughly 3 to 3.5% growth in the third quarter. If you look at the blue chip consensus, that's a little bit lower, a little bit above 2%, but still very strong growth overall. This is one of the reasons that the Federal Reserve might pause on lowering rates, or at least lower them a little bit slower, just because GDP growth has been so strong, and it's really been quite shocking to so many analysts and investment advisors out there.
Yeah, and that's another piece of good news. We've been harping on the good news. Stanley, let's try to find some problems in the economy. Here's a chart that might have a canary in the coal mine. Do you want to walk us through what you're looking at here and what might be something that turns the economy?
Yeah, so this is a chart we've shown a number of times before. And what I want to focus on is the bottom right, flows into early delinquencies. When we were looking at auto loans and credit card loans in blue, those have really come up quite a bit since 2021, 2022. Now, they're not as high as they were when they peaked during the financial crisis, but they have come up quite substantially from that 4, 5, 6% range. Now they're respectively at 8% for auto loans and 9.1% for credit card loans. That is a number that we need to watch. Generally speaking, those precede an economic downturn. So if those numbers are rising, it's not a good sign. That being said, it's not the biggest deal in the world. If we go to the chart right above that, household debt service ratio, debt payments as a percentage of household income is now at 10%. It's off of the lows of close to 8%, but it's really right in line for where we were around 10% ever since the great financial crisis. And if we look back to the housing market crisis and the great financial crisis, it peaked at 13.3%. It's down substantially since then. So households, even though the debt service ratio is a little bit higher, it's still not quite as worrisome. The auto loans and credit card loans are definitely something to be monitored going forward. Looking at the left side with the consumer balance sheet, I would just note that the consumer is still in a really strong position. Households have a total of $185 trillion in assets versus $20.7 trillion in liabilities. So really, they have nine times as much assets as they have liabilities. On top of that, the liabilities are 2/3 in mortgages. The vast majority of those mortgages are 20, 30-year mortgages locked in at fixed rates, 2, 3, 4%. They're not generally as high as the current mortgage rates of 6 or 7%. We haven't seen many new mortgage issuances. Generally speaking, the consumer is in pretty solid shape.
Yeah, and of those financial assets, the 42% there on the bottom left, roughly 9% of those are in cash or in money market funds. And this chart shows money market funds growth over the years. And it's not surprising that money markets have grown to almost $7 trillion because the rates have been higher. As the Fed has raised rates, those money market funds have been very attractive, especially vis-a-vis savings accounts, right? So we've had a lot of clients over the last year or two moving money out of their savings accounts into cash equivalents because they can get a higher rate of return. Well, what happens when the Fed lowers rates? Those cash equivalents begin to have less attractive yield. In fact, at 4.75, they're still relatively attractive. But if we follow the Fed dot plot down to 3%, if the Fed's targeting 2% inflation with a 3% money market yield, there's not a lot of real return left, and that money tends to find a home. So this is another reason why we're optimistic. This money shouldn't stay in money market funds forever. And as rates continue to move lower, it can find a home in either bonds or stocks or other investments that might have a higher rate of return. And that would provide a bid under those markets. All right, so the third rail of investment advice, we're going to talk about the election coming up. As is our theme today, market timing is hard to do. But first, we showed this slide last quarter. We're going to show it again this quarter. Stanley, why is it important to know your biases in terms of how you manage your portfolio?
So everybody has their own biases, whether they're political or other areas. And what we're looking at here is consumer confidence by political affiliation. And it's pretty much exactly what you'd expect. In the first portion of the chart, when President Bush became president from January 2001 through 2009, Republicans tended to have a far more rosy outlook on the economy and consumer confidence. Democrats were a little bit more negative. And then lo and behold, the day Obama gets elected, all of a sudden Democrats are a lot more rosy and Republican consumer confidence tanks. And then switches back to Trump. All of a sudden, Republican consumer confidence goes way back up. Democrat consumer confidence isn't quite as high. And then switch it back when it goes back to Biden. So the point here is that their confidence in the market, in the economy, really is derived based on who they think is in power, even though it doesn't actually really change the underlying economy or market that much. People let their biases really kind of get into their decision making, which we don't want to have.
Yeah, and we're all following the election. We all know how close it is. Cutler does not have a crystal ball to tell you who's going to win in 2 weeks. This is just a chart that shows the polls really show it as a dead heat. The election, and this is part of what we're trying to get across in this section of our presentation. Stocks are a long-term investment that have been a good investment in both Democrat and Republican regimes. Policy does matter. It matters a lot to you personally, and it matters a lot to the country. And things like, what is your estate planning? How is your tax planning? Those are questions that we think are important to ask really on that fundamental financial planning perspective. But should you sell your stocks? Stanley, well, I'll address this chart first. This is showing Congress in a dead heat as well. So not only is the presidential election very tight, but also the congressional election is very tight. But Stanley, let's talk about the returns of stocks under these different possibilities.
Right. So on the left side, we have the election outcome, whether it's unified Republican, unified Democrat, that would be the House and Senate, along with the presidency. Divided House and Senate may go Democrat, while the presidency goes Republican, or vice versa. And what I'd like to point out is that the S&P 500 annual average return is really about the same, regardless of whether it's a Republican in power or Democrat in power. 14.5% versus 14% for full unified party control. That is statistically significant in that it's, pretty darn close. If you look at the divided governments, again, still overwhelmingly positive. So the point is, even if your candidate does not win, what I would say is still stay invested. Over the long term, businesses tend to produce profits. They tend to grow over time. And overall, the market tends to go up regardless of who's in power. I would say you don't want to shoot yourself in the foot or have an opportunity cost of selling out of stocks, having them go up just because your candidate did not.
Yeah, here's another way of looking at that. Again, a market timing chart here. If you had lucky enough to invest $10,000 in 1948 and didn't need it for the next, how many years is that? 85 years. Here's how you would have done if you had invested only under a Republican president, you'd have 311,000. If you'd invested only under a Democrat president, you'd have 1.2 million. If you had invested the whole time, you would have 37.8 million. So again, another data point really stressing if your candidate does not win next month, that's okay from an investment standpoint. You keep that long-term approach, keep that diversified portfolio, and make sure you're sticking with your plan. Here's another not election related slide, but really a time in the market slide. And we like to say it's not timing the market, it's your time in the market. And you can see as the longer your holding period, the greater your chances of success in the stock market. So tomorrow, historically, there's a 53% chance stocks will be up. And on November 23rd, historically, there's a 62% chance stocks will be up. But let's look out 5 years. There's an 89% chance stocks will be up. In 10 years, there's a 94% chance stocks will be up. I believe the only time stocks were down in a 10-year period was surrounding 1929 with the Great Depression. And then there was another period of time that was bookended by the tech crash as well as the Great Financial Crisis, which were about 10 years apart, and stocks were negative for a 10-year period in there. But most of the time, the vast majority of the time, if you're looking out 3, 5, 10 years from now, stocks have been positive. And we don't have reason to believe that will change. Perhaps valuations mean the return from stocks aren't as attractive as they have been for the last 10 years. But this chart still holds true in many different valuation environments. And so we would advocate continuing to own your stocks and continuing to think long-term in your portfolio. I mentioned a slide or two ago about planning you can do around an election. And things that you might do. The Tax Cut and Jobs Act, for example, is going to be an issue next year for either candidate because that's due to sunset. Reach out to your financial advisor at Cutler. Let's talk about how that might impact your personal portfolio, or visit cutler.com. Our financial advisors have done a great job of putting videos on there that address a lot of the issues on this page, and we invite you to stop by, take a look, and hear what we're saying about a lot of these different topics. If you do have questions about investments or anything on this page, please reach out to us. And with that, thank you so much for your time today. Stanley and I do this quarterly, and we'll have a lot to say in January as the market wraps up the year, as well as we know what's happened politically out there. So stay tuned. And we look forward to seeing or talking with each of you in the meantime. Thank you so much.